Disclaimer.
While the world stares in disbelief at the screens watching silver crash to $75, something far more dangerous is happening behind the scenes. President Trump just signed Executive Order 14099, freezing Canadian capital flow, and with it, the very plumbing that feeds the U.S. physical silver market. I just got off the phone with 3 major national dealers. Their message? We have nothing left. The Comex is bleeding. The Canadian border is now a financial firewall. And what you're seeing on the charts is not a sell-off. It's the ultimate volatility trap designed to shake you out before the physical supply vanishes forever. Today, I'm showing you the leaked data Ottawa is trying to hide, and why $75 silver is the biggest lie in financial history. Let me walk you through exactly what happened and why this moment represents the most critical decision point for anyone holding dollars who wants to own real silver. Here's the timeline that connects everything. You're watching silver climb to heights not seen in decades, finally breaking past $120 an ounce. Your portfolio is looking good, your physical stack is appreciating, and then in just 30 hours on January 29th and 30th, everything collapses 35%. The worst single-day crash since 1980. Your screen shows $75, and panic floods every trading forum and precious metals community across our country. But here's where something truly bizarre happened that should grab your attention immediately. While the paper price was cratering on your screen, try calling any major bullion dealer in America to actually buy physical silver at that crashed price. What thousands of Americans discovered on February 1st is what I confirmed this week. Every single major dealer was either completely sold out, showing 2 to 4 week delivery delays, or charging premiums $8 to $12 above that crashed spot price flashing on your screen. Think about what that means. The official price says silver crashed, yet you cannot buy the actual metal anywhere near that price. In fact, you might not be able to buy it at all for weeks. This isn't how markets are supposed to work when prices collapse. When something crashes 35%, supply should flood the market. Sellers should be desperate. Dealers should be cutting prices to move inventory. The exact opposite happened. And when you layer in what's happening with Canadian flows right now, you start to see why this is not just a temporary shortage. It's a structural supply crisis that's been building for months and just hit a breaking point. Let me take you inside the mechanics of what actually caused that January crash, because understanding this reveals why the physical shortage is so severe. Silver had climbed to $121 an ounce, driven by a perfect storm of inflation fears, banking sector concerns, and what looked like the beginning of a major precious metals bull run. Retail investors were buying, institutions were accumulating, and momentum was undeniable. Then, too, events hit the market like a coordinated 1-2 punch. First, the CME, the Chicago Mercantile Exchange, where silver futures trade, raised margin requirements to 15%. For those who don't trade futures, here's what this means for understanding the market. When you trade futures contracts, you don't put up the full value of the contract. You put up a fraction called margin. The CME just forced traders to put up significantly more cash to hold their positions. Suddenly, leveraged speculators who were riding the silver wave with borrowed money got margin calls they couldn't meet. Here's the critical detail. These speculators never wanted actual silver. They were trading 5,000-ounce paper contracts that represent silver, betting on price movements. When margin requirements jumped, they had to either put up more cash immediately or sell their positions. Most chose to sell. Fast. Then came the second punch. News broke that Kevin Warsh was being nominated as Federal Reserve Chair, and Warsh has a reputation as a monetary hawk. Translation for regular Americans. Higher interest rates, tighter money, and traditional thinking that says those conditions are bad for precious metals. The algorithmic trading system saw the headlines, processed the data, and started dumping silver positions automatically. What followed was a cascading liquidation event that fed on itself. As prices fell, more margin calls triggered, more forced selling, more algorithms detecting downward momentum and piling on. In 30 hours, paper silver contracts worth billions were dumped onto the market by speculators who were never going to take delivery of actual metal. The price collapsed from $121 to $75. Not a single ounce of real silver changed hands in that crash. It was purely a paper liquidation event. Meanwhile, what happened to Americans who actually wanted physical silver? According to data from SD Bullion, one of our nation's largest online dealers, they saw order volumes spike 400% during the crash. Comex, another major dealer, reported their inventory of American silver eagles, the most popular coin among USD stackers, sold out within 6 hours of the price touching $75. JM Bullion suspended taking orders for certain products entirely because they couldn't fulfill the backlog they already had. You see the disconnect? Paper silver is flooding out of the futures market while physical silver is being bought faster than dealers can source it. The crash that looked devastating on your screen was actually creating the most aggressive physical buying opportunity in years, and Americans with cash ready jumped on it immediately. But here's where the Canadian situation makes this infinitely more serious. Canada is the 8th largest silver producer in the world, and according to Natural Resources Canada data, Canadian refineries supplied approximately 12 to 15% of physical silver that flows into U.S. dealer networks over the past 3 years. That's everything from maple leaf coins to industrial-grade bars that get melted down and recast for American retail products. Executive Order 14. 099 didn't just freeze Canadian capital flows as a political measure. It effectively cut off a major artery feeding physical silver into our domestic market at the exact moment demand exploded. The dealers I spoke with confirmed what the data shows. Their Canadian suppliers can't ship product across the border because the financial settlement systems are frozen. Even if the physical metal is sitting in a vault in Toronto, it can't be paid for under current restrictions, so it can't move south. Think about the timing here. Just as paper speculators are dumping contracts and creating the illusion of a price crash, one of our key physical supply channels gets cut off. Americans see $75 and rush to buy, but the metal they're trying to buy is stuck on the wrong side of a financial firewall that was not there 2 weeks ago. Now, layer in what's happening in the institutional market where banks and mining companies actually borrow and lend physical metal. There's a metric called the silver lease rate. Under normal conditions, this rate sits around 0.3 to 0.5%. The interest rate someone pays to borrow physical silver for a month. During the week of January 29th, that lease rate exploded to 8%. Let me put that in perspective. The institutions that need actual physical silver are now paying 1,600% more than normal just to borrow the metal for 30 days. When borrowing costs spike like that, it means one thing: there isn't enough physical metal available to meet demand. The institutions who need real silver, not paper contracts, but actual bars in a vault, are competing desperately for whatever's available. The World Gold Council, which also tracks silver market data, noted in their February report that lease rate spikes of this magnitude historically only occur during severe physical shortages. They pointed to similar events in 1980 during the Hunt Brothers saga, and in 2011 during the first major post-financial crisis, precious metals run. Both times, lease rate explosions preceded extended periods where paper prices and physical availability completely diverged. Here's what this means for you trying to understand our financial markets right now. We're watching a market split into two completely different realities. In one reality, the paper futures market, silver crashed hard and speculators got massacred. In the other reality, the physical market where actual metal changes hands, silver became immediately scarce and dealers can charge whatever premium they want because customers are willing to pay it to secure real metal. Federal Reserve data on precious metals flows shows something equally revealing. In the week following the crash, domestic vault inventories at major commercial banks dropped by their largest weekly amount in 18 months. Banks weren't adding to reserves during a price crash like you'd expect. They were drawing them down. That means someone with serious institutional backing was pulling physical metal out of the banking system while the paper price was collapsing. Ask yourself, who pulls metal out during a crash unless they know something about the real supply situation that the paper price is not reflecting? The mainstream financial media barely covered this divergence. They reported the crash, that's dramatic and gets clicks, but they completely missed the story underneath. The paper market can be manipulated by margin requirements and forced liquidations, but the physical market reveals the truth about actual supply and demand. And right now, that truth is telling us that real silver is far scarcer than the crashed price suggests. When you add the Canadian supply disruption to this equation, you understand why dealers are telling customers that delivery times are stretching to 3 and 4 weeks. It's not just high demand. It's high demand hitting a supply network that just lost a major input source with no clear timeline for when that changes. So when you see that $75 price on your screen and think silver is cheap, remember that the actual cost to acquire physical metal with your dollars is closer to $85 or $90 after premium. Let's talk about the data that should be making headlines across every financial network in America, but isn't. While everyone's focused on the dramatic price crash and recovery, there's a quiet exodus happening at the Comex that tells you everything about where this market is really headed. The Commodity Exchange, our nation's primary futures market for precious metals, tracks 2 categories of silver inventory: eligible and registered. Eligible means the silver meets exchange standards but isn't available for delivery against futures contracts. Registered means it's actively available to settle contracts. It's the metal that actually backs up the paper promises being traded. That registered category is what matters when someone wants to convert their futures contract into actual physical silver. Here's what happened between January 12th and January 19th, right before the crash. Comex registered silver inventory dropped by 33.45 million ounces in a single week. That's a 26% decline in 7 days. According to the CME Group's own data, this represents the fastest drainage rate of registered inventory since they started publishing these figures with the current methodology in 2008. Let me put that number in context for you. 33 million ounces withdrawn in 1 week. Annual global silver mine production is roughly 820 million ounces, according to the Silver Institute's latest World Silver Survey. That means in 1 week, 4% of annual global mine production was pulled out of the Comex registered inventory and delivered to buyers who wanted physical metal, not paper contracts. Who's taking delivery at these levels? The CME doesn't publish names, but their delivery reports show the activity. In January alone, we saw delivery notices for over 60 million ounces of silver, more than double the typical monthly average. These aren't retail investors taking delivery. Retail doesn't touch Comex directly. These are institutions, banks, industrial users, and large funds that have the infrastructure to take possession of 5,000-ounce bars and vault them. Now here's why this matters for understanding whether this shortage is temporary or structural. After those withdrawals, the Comex is sitting on approximately 95 million ounces of registered silver as of February 7th. The Chicago Mercantile Exchange data shows this clearly in their daily warehouse stocks report. Industrial demand for silver in the United States alone runs about 150 to 170 million ounces annually, according to the Silver Institute. That's the silver used in solar panels, electronics, medical equipment, and other applications. It doesn't include investment demand. If you divide that industrial demand across 12 months, you're looking at 12.5 to 14 million ounces of monthly industrial consumption just in our country. The Comex currently holds enough registered silver to cover roughly 6 to 7 weeks of U.S. industrial demand if all other supply sources disappeared. That's the buffer between normal operations and a shortage that forces production shutdowns. 6 weeks? And that inventory just dropped 26% in 1 week, while demand is accelerating, not slowing. But the drainage isn't stopping. According to the most recent warehouse stock reports, registered inventory continued declining through the end of January and into early February. We are now watching a structural unwind where the traditional buffer that kept the paper market functioning is being systematically removed by buyers who want the physical metal. The Bank for International Settlements published research in late 2024 analyzing precious metals market structure. And one of their key findings was that Comex registered inventories need to maintain at least 80 to 100 million ounces to ensure market stability and prevent delivery failures. We're now at the bottom end of that range, and the withdrawals aren't slowing down. Now let's connect this to what China just did, because this is where the supply shortage becomes permanent, not temporary. In December 2025, the Chinese government reclassified silver as a strategic material. This wasn't a minor regulatory change. According to official statements from China's Ministry of Commerce, silver now joins rare earth elements, tungsten, and other materials deemed critical to national security and technological development. What does that classification actually mean in practical terms? In January 2026, China imposed export restrictions on refined silver. Not a complete ban, but a licensing requirement that effectively throttles how much silver can leave the country. The China Non-Ferrous Metals Industry Association reported that licensed exports for Q1 2026 were set at 40% below 2025 levels. Here's why that matters. China produces roughly 20% of global refined silver, according to the U.S. Geological Survey's latest mineral commodity summaries. They're the world's third largest producer behind Mexico and Peru. But more importantly, China refines significant amounts of silver from imported concentrates and recycled material. When you add domestic production and refining capacity together, Chinese refineries were supplying approximately 15% of the refined silver that enters global markets available for purchase. That 15% just got cut by 60% through export restrictions. In a market already running a structural deficit, China just removed roughly 9% of globally tradable supply with the stroke of a pen. And they did it in January, the same month the Comex started bleeding inventory, and the same month the paper crash created massive physical buying demand. Think about the strategic calculus here. China watches silver climb to $120. They see the demand surge. They understand that silver is critical for their domestic solar panel manufacturing. electronics production, and emerging technologies. What do? They ensure domestic supply stays domestic. They weaponize their production capacity the same way they've weaponized rare earth elements. The Global Times, which reflects Chinese government thinking, published an analysis in late January explaining that silver is essential for China's green energy transition goals and semiconductor independence. The subtext was clear. This metal is too important to let it flow freely to global markets when domestic demand is accelerating. Now here's where it gets even more concerning for anyone expecting supply to respond to higher prices the way Economics 101 teaches us it should. On January 28th, Fresnillo plc, the world's largest primary silver producer, cut their 2026 production guidance by 10%. This is a company that produced approximately 53 million ounces of silver in 2024, according to their annual report. They just told investors to expect roughly 5 million fewer ounces this year. Why? In their production update, Fresnillo cited lower ore grades at multiple operating mines and accelerated depletion at higher grade veins in Mexico. Translation? They're digging deeper, the rock contains less silver per ton, and the easy-to-access high-grade deposits are getting exhausted. This is peak silver playing out in real time. But Fresnillo isn't alone. Hecla Mining Company, one of the largest silver producers in the United States, released their operational outlook in late January. According to their guidance, they are projecting flat to slightly declining output for 2026 compared to 2025, despite silver prices that are 3 times higher than they were 3 years ago. Read that again. Silver went from around $25 to over $75 currently, touching $120 recently, and the supply response from primary producers is flat to declining. That's not how commodity markets are supposed to work. Normally, when prices triple, producers expand operations, open new mines, reopen shuttered facilities, and increase output. But silver mining doesn't work like that anymore because of the geology. According to the Silver Institute's analysis, roughly 70% of silver production comes as a byproduct of mining for other metals, primarily copper, zinc, and lead. Only 30% comes from primary silver mines. That means even when silver prices surge, production doesn't respond unless copper, zinc, and lead prices also justify expanding those operations. We're seeing copper prices relatively stable, and base metals demand from China is uncertain given their economic slowdown. So the byproduct silver supply isn't increasing, even though silver itself is in a historic price rally. The few primary silver producers we do have are running into geological constraints. The CPM Group, which tracks precious metals, supply and demand fundamentals, published analysis showing that average ore grades at major silver mines have declined approximately 30% over the past 15 years. Miners are processing more rock to get the same amount of silver, which increases costs and limits how much they can expand even when prices are high. Meanwhile, recycling isn't picking up the slack. The Silver Institute estimates that recycled silver supply represents only about 15% of annual supply, and that percentage has been relatively stable. There's no evidence that the recent price surge has triggered a flood of recycled material. Industrial silver once used is often uneconomical to recover. The amount in a solar panel or circuit board is so small that recycling infrastructure does not exist at scale, so we have declining Comex inventories, Chinese export restrictions, cutting 9% of global tradable supply, and primary producers unable or unwilling to increase output despite prices tripling. The question every American holding dollars needs to ask is, where is the supply going to come from to meet demand? The World Silver Survey, published by the Silver Institute, shows that the silver market has been running a structural deficit for 6 consecutive years through 2025. That means annual demand exceeds annual supply from mining and recycling. The deficit for 2025 was approximately 95 million ounces. Physical inventories globally have been drawing down to fill that gap. But here's what should really concern you. That 95 million ounce deficit was calculated before the recent price surge created the investment demand surge we're seeing now. It was before the Comex started bleeding 30 plus million ounces per week. It was before China imposed export restrictions. The actual deficit for 2026 is going to be substantially larger than 95 million ounces, and nobody knows where the supply comes from to fill it. The London Bullion Market Association, which tracks the professional over-the-counter precious metals market, reported in their January vault holdings data that silver inventories in London, the other major global trading hub besides Comex, declined by 12 million ounces in December and another 8 million in January. So it's not just New York bleeding inventory. London is too. Between Comex and London, you're talking about roughly 50 plus million ounces of inventory withdrawn in less than 8 weeks from the 2 primary transparent inventory pools that backstop global silver trading. Annual mine supply is 820 million ounces. so roughly 6% of annual production, just got pulled out of the visible market and put into strong hands that aren't selling. Some analysts are pointing to above-ground silver inventories as a buffer. The CPM group estimates there are roughly 2 billion ounces of silver in identifiable above-ground stocks globally. But here's the problem with that number. Most of that silver isn't for sale. Let us talk about what's happening right now as we head into Monday, February 9th, with silver closing Friday at $76.85. Because if you understand the technical setup, the systematic fund positioning, and the options market dynamics currently in play, you'll see why this weekend might be the last chance to make a decision before the market reprices dramatically. Here's the technical picture. Silver peaked at $121 on January 29th before the crash took it to a low of $75 on January 30th. That sell-off found resistance, where the selling began, at $94.80. You can see this clearly on any daily chart. That $94.80 level was tested 3 times during the decline. Once on the way down, once on a brief bounce, and once more as the final capitulation selling pushed through it. In technical analysis, when a price level is tested multiple times like that, it becomes a major line in the sand. For algo-driven trading systems and systematic funds, that $94.80 level is now programmed into their models as confirmed resistance. Here's what that means in practical terms. If silver breaks back above that level, those systems will interpret it as a failed breakdown and trigger buy programs. The Commitment of Traders report from the CFTC, which shows positioning in futures markets, reveals that, as of February 4th, the most recent data available managed money, that as hedge funds and systematic traders, is net short silver for the first time since October 2023. They're positioned for lower prices, they sold the crash, and haven't bought back yet. What happens when shorts are wrong? They cover. And when systematic funds cover shorts in a commodity that's showing physical shortage, they don't ease into it. They hit market buy orders to close positions quickly. That kind of covering creates explosive upward moves, especially in a market where physical supply is tight and dealers can't source metal quickly. Now let's talk about the gold to silver ratio, because this is where the mechanical repricing comes in regardless of what fundamental news hits the tape. The gold to silver ratio, as of Friday's close, stands at 64-1. That means it takes 64 ounces of silver to buy 1 ounce of gold. Gold closed Friday around $4,900. Do the math. 4,900 divided by 64 equals roughly $76.50, which aligns with where silver closed. But here's what you need to understand about this ratio. During the January silver rally, before the crash, the ratio compressed to 45-1. That was silver at 121 and gold around 5,400. The crash in silver, while gold held relatively firm, blew that ratio back out to 64-1 in a matter of hours. Historically, according to data compiled by Incrementum AG in their annual In Gold, We Trust report, the gold to silver ratio averages around 65-1 over very long time periods. But during precious metals bull markets, that ratio typically compresses to between 40 and 55-1. We saw it hit 45 before the paper crash. If gold holds in the $4,900 to $5,000 range, and gold's technical picture looks solid with central banks still accumulating and geopolitical tensions supporting safe haven demand, and the ratio reverts to its bull market average of 50-1, you get mechanical repricing in silver. Let me show you the math. If gold is at 4,900 and the ratio goes to 50-1, silver mechanically reprices to $98. No new fundamentals needed, no additional shortage catalyst required, just mean reversion in a ratio that got blown out by forced paper selling and tends to revert during bull markets. If gold edges higher to 5,000 and the ratio compresses to 48-1, which we saw briefly in January, silver reprices to $104. That's a 35% move from current levels based purely on ratio dynamics. The options market is starting to price this possibility. Open interest data from the CME shows massive concentration of call options at the $100 strike expiring in March and April. As of February 7th, there were over 12,000 contracts open at the $100 strike for March expiration alone. Each contract represents 5,000 ounces, so that's 60 million ounces of silver that could be called if price reaches $100 before March expiry. When options dealers sell call options to speculators, they hedge their exposure by buying futures or physical metal as the price approaches the strike. This is called delta hedging. Right now, those $100 calls are far out of the money, so dealers haven't hedged much. But if silver starts moving toward $90, those dealers will need to start buying aggressively to hedge their exposure. That buying creates additional upward pressure, which can trigger more hedging, creating what's called a gamma squeeze. We saw this exact dynamic play out in GameStop in 2021, in nickel in 2022 when it gapped limit up, and we're seeing the setup form in silver right now with massive call open interest concentrated at round number strikes above current price. So you have systematic funds positioned short, a gold-silver ratio that's historically stretched, and prone to mean reversion, options dealers who will need to hedge if price moves toward key strikes, and a physical market that can't deliver metal at current prices. That's a coiled spring, not a market that's found equilibrium. Now, let's talk about what happens Monday morning when Asian markets open, because that's where the first price discovery occurs each week. Silver trades 23 hours a day across multiple time zones. The Asian session opens Sunday evening U.S. time, and that's often where moves begin before U.S. markets catch up Monday morning. If news hits over the weekend about the Canadian situation worsening, or if China announces additional export restrictions, or if a major dealer publicly announces they're suspending sales due to inability to source metal, the Asian market will gap silver higher immediately. Traders in that session won't wait for U.S. markets to open. They'll bid aggressively, knowing that U.S. market participants will chase when they wake up. Here's the scenario that should concern anyone who's been waiting to buy physical silver. Let's say Asia gaps silver to $82 on Sunday night. U.S. futures open Monday morning and quickly trade up to $85 as systematic funds start covering shorts and momentum traders jump in. By the time U.S. bullion dealers open their phone lines Monday morning, what price do you think they'll be quoting? Dealers don't sell at spot price. They add premiums based on their cost to acquire metal plus their margin. If spot gaps to $85, dealers who are already quoting $8 to $12 premiums will reset their ask prices to $95 to $100 for immediate delivery. And for those 3-week delayed orders, they'll price in where they think spot will be in 3 weeks, which could be even higher. This is how a two-tier market develops. The paper spot price might show $85, but try buying physical silver anywhere near that price. You can't. The physical market is trading $10 to $15 over spot, and that spread widens as the shortage intensifies, and delivery delays extend. I've spoken with dealers who've been in this business for 20 and 30 years, and they're telling me they've never seen a disconnect this severe. During the 2011 silver spike, premiums were elevated, but you could still get metal within a week or two if you were willing to pay. Right now, even at elevated premiums, delivery timelines are stretching to 4 weeks, and some products are simply unavailable at any premium. The data from aggregator sites like findbullionprices.com, which tracks real-time dealer pricing across dozens of major U.S. retailers, shows that as of Friday afternoon, the lowest available price for a generic 1-ounce silver round was $88.50, including shipping. That's a $12 premium over the $76.85 spot close. American Silver Eagles, the most popular product, were showing lowest price of $91.95. That's a $15 plus premium. So when the financial media tells you silver is trading at $76, understand that's a fiction for most Americans trying to actually buy the metal. The real price, the price you can transact at with cash in hand, is already in the high 80s for generic products and low 90s for recognizable sovereign coins. Now think about what happens if spot gaps up Monday. Those premiums don't compress. They maintain or widen because dealer costs are rising and supply is tightening. If spot hits 85, physical might be trading at $98 to $100 by Tuesday. If spot reaches 92, physical could be at $108 to $112 within days. This creates the binary decision that Americans holding dollars need to make before Monday's open. Option 1, you buy physical now at current premiums of $8 to $12 over spot, accept a 3 to 4 week delivery window, and lock in metal in the high 80s per ounce. Option 2, you wait to see what happens Monday, hope for another dip, and risk a gap-up scenario where physical metal reprices $10 to $20 higher overnight while you were sleeping. The risk-reward on that decision should be obvious to anyone who's looked at the data I've just laid out. The fundamental supply shortage is real and documented. The technical setup favors explosive upward moves. The ratio dynamics point to mechanical repricing. The options market structure creates gamma squeeze potential. And the physical market is already trading $10+ over paper spot with extending delivery delays. What's the upside to waiting? Hoping paper silver dips to $70 or $65? Even if that happens on paper, dealers aren't going to suddenly have inventory flood in and premiums collapse. The physical shortage isn't driven by sentiment. It's driven by structural supply deficits, Chinese export restrictions, Comex drainage, and Canadian flow disruptions. None of those reverse just because paper speculators dump more contracts. Meanwhile, the downside to waiting is that you wake up Monday to a market that is gapped higher and physical silver is suddenly only available at $95 to $100 if you can find it at all. The dealers I spoke with this week said they're prioritizing existing customers and large orders. If Monday brings a flood of new buying, smaller retail orders could get pushed back even further. Let's look at what specific technical triggers could drive Monday's open higher. First, the overnight inventory reports from Comex. These publish Sunday evening, showing registered inventory changes through Friday. If we see another 5 to 10 million ounce withdrawal, that'll hit trading screens in Asia and trigger algorithmic buying. The machines are programmed to react to inventory data. Second, any news flow regarding the Canadian executive order. If there is clarification that extends the financial restrictions, or if Canadian miners publicly comment on the disruption to their U.S. sales channels, that'll be interpreted as supply negative and bullish for price. Third, China's official silver import-export data for January publishes in mid-February. If preliminary leaks show that exports fell even more dramatically than the 40% guidance suggested, or if imports rose, showing domestic demand acceleration, that'll confirm the supply shortage thesis and trigger institutional buying. Fourth, watch for any major industrial user signaling supply concerns. If a solar panel manufacturer or electronics company issues a statement about difficulty sourcing silver or rising input costs, that validates the shortage narrative beyond just the investment market. The technical chart is also showing a potential bullish engulfing pattern if Monday opens strong. After Friday's close at 76.85, we're sitting right at the boundary of a make-or-break zone. The 50-day moving average is around $78, and the 200-day moving average is near $82 based on current data. If Monday breaks through both of those with volume, technical systems will flash buy signals, and trend followers will pile in. The relative strength index, which measures momentum, is sitting at 54 after Friday's close. That's neutral territory, not overbought, not oversold. There's plenty of room for RSI to run higher before hitting overbought levels around 70, which means momentum traders have clearance to buy without worrying about chasing exhaustion. Now let's address the elephant in the room. What if the powers that be don't want silver to rise? What if there's another margin requirement increase or another coordinated paper dump to knock price down? That's certainly possible. The paper market can be manipulated in the short term. But here's what's different this time compared to previous silver rallies that got capped. The physical market has separated from the paper market in a way that has never happened before at this scale. Lease rates at 8% confirm that institutions can't get physical metal without paying extreme premiums. Dealer inventories are depleted with month-long delivery delays. Comex registered inventory is at minimum viable levels. Previous silver rallies were capped because when paper price rose, supply would materialize. Scrap recycling would increase, above-ground inventories would come to market, dealers would have metal to sell. That pressure release valve worked. This time it's not working. The supply isn't materializing because it doesn't exist at these prices, and the structural deficit means every year we're drawing down inventories that can't be replaced. So even if they knock paper silver down to $60 or $50 through another forced liquidation event, the physical market won't follow. Premiums will explode to $20 or $30. Delivery delays will extend to 2 or 3 months. And eventually,